afternoon, everyone, and welcome to Low Load Insurance Services' 6th webinar of 2012. We showed you some scrolling slides a few moments ago that filled you in on CEs and some other important information. If you missed any of that, it is on our website, so just visit llis.com and you can see that. Today's presentation will review some of the more common acronyms used in the insurance industry and what they mean to you and your clients. It'll last about 50 minutes. And if you have questions during those 50 minutes, you can submit them on screen, and Mark will get to them as he can. And then at the end of the presentation, he will open the phone lines for individual questions asked verbally. Remember that to ask those verbal questions, though, you have to use the audio PIN number that was provided when you logged in. As a reminder to you, this webinar, like all of our webinars, is being recorded and will be posted to our website within about a week. So if you have colleagues who couldn't attend today, please let them know they can view the presentation soon. Your presenter today is Mark Maurer, who is living proof that sometimes tradition is a good thing. He joined Low Load in 2003, assumed his current role as president in 2008. He's got his CFP that he got in 2006 that complements his bachelor's degree in business and finance and his MBA. He's a member of the National Association of Insurance and Financial Advisors, a popular speaker for financial organizations like the Alliance of Cambridge Advisors, NAPFA, Garrett Planning Network, LIMRA, LOMA, and Society of Actuaries. He is a contributing author to Business Week, Bloomberg.com, Forbes, NAPFA Advisor, AMA Physician's Guide to Financial Planning, and Jane Bryant Quinn's book, Making the Most of Your Money Now. So he is an insurance industry resource to those industry publications. So everyone, PWM, please welcome to the mic, Mark Maurer.
Well, howdy, buckaroos. It's Mark Maurer time again, and we're going to start today with UIA, so take a load off. Hopefully everybody's going to have fun. We're going to talk about understanding insurance acronyms. One second here. Now, not all of these are ours. You may get a little dizzy looking at all these. I know I do. But today we're going to try and take a number of these, and you're looking at it and you're probably thinking, OMG, that's a lot of acronyms there. Well, we're going to try and do a lot what we can to simplify a number of these and hopefully make them more understandable for you, and so that when your clients have these questions about these different acronyms, you'll be more comfortable answering questions about them. So what do all these different acronyms mean? We're going to talk about that. Are they important? Some of them sound pretty scary, and for the most part, it really doesn't mean much in many scenarios. How do they benefit my clients? A number of the FIOs or the GPOs or COLA riders can actually add a lot of benefits to your clients' different types of policies. We're going to do a little FYI on life. ADB is the Accelerated Death Benefit Rider. There's a number of different qualifications that can fall under an Accelerated Death Benefit Rider. There's a terminal illness rider. Most life insurance policies have a rider that says if you are diagnosed, it's determined by a medical professional that you have 12 months or less to live, you can accelerate some of the death benefit of a life insurance policy. It's a nice benefit, but very rarely is a client ever actually able to use that one, just because you have to have a doctor who's guaranteeing that or signing off that somebody has 12 months or less to live, and medical improvements are happening every day. Chronic illness is the long-term care insurance rider. This is used much more frequently and is being added to life insurance policies almost on a monthly basis. I just got a notification today that Transamerica is going to start offering a long-term care benefit rider to their universal life policies, and so a number of companies are adding a chronic illness or a long-term care ADB to their policies that allow you to access a death benefit early. Other carriers have some that's called a specified condition accelerated death benefit rider. If you are diagnosed with If you have a heart attack, you may be able to get up to 5% of the death benefit. If you have a stroke, another 5%, not to exceed 10 or 15%. Less frequent, the specified conditions not on many policies. But those are all types of ADBs, or the accelerated death benefit riders. Not to be confused with AD&D or ADD, accidental death, or accidental death and dismemberment. This is most common as an employer benefit. Your clients work for a larger employer. They may have the option to buy up some AD&D, or it's even provided as an employee benefit. Most often it's provided through employers. There are more frequently you can add it as an extra benefit to a life insurance policy. There's one company I know of that actually offers a standalone accidental death policy. It's generally relatively inexpensive. The issue being, though, that compared to life insurance, you're either dead or you're not. There's not really a subjectivity to paying a claim. Accidental death is that the insurance company must agree that it was an accident. So you would say someone falls off their roof and dies. Well, that's most likely, we'd all call that an accident. But if it's determined that because the client had a heart attack, a stroke, some medical thing that caused them to fall off the roof, the insurance company is going to say that's a medical or organic reason, that's not an accident, not pay. So you can probably guess my sense of that we don't often recommend these policies unless it's hard for someone to get that standalone life insurance coverage. WOP, waiver of premium. This can be added to most life insurance policies. If a client is considered disabled by the life insurance company, may be able to waive premiums so that they don't have to pay premiums while they're on claim. This is generally an expensive disability policy compared to standalone disability coverage. And a friend of you have asked me about this before. I've run comparisons that for the dollar you spend on a waiver of premium rider compared to how efficient it is compared to a standalone disability policy, it may be a small dollar premium on a life insurance policy, but the cost-to-benefit ratio is usually pretty inefficient compared to a standalone disability policy. So again, there may be times when this is favorable to add to a policy because of underwriting or occupation or other things, but for the most part, we don't recommend those when the standalone disability coverage, either as an employer benefit or individual disability policies, are available. An ILIT stands for Irrevocable Life Insurance Trust. I think sometimes this confuses people, and rightfully so sometimes, because a mom and dad might set up an ILIT to have a life insurance policy on their lives for the benefit of their kids. The IRS, though, says that this ILIT must be separate from the insureds. And for it being separate, the death benefit is removed from mom and dad's taxable estate, but it also requires that the donors have no ownership. Again, mom and dad set up the trust, they're gifting the premiums to the trust to pay for the life insurance policy, but they don't actually own it. And the IRS says you can't have any incidents of ownership, or else that death benefit's going to be included in your taxable estate. So it feels like I have this, the life insurance is on me, I pay the premiums, but in reality, I don't have any control over it much anymore because a trustee does. Once you give it, it's gone. The money that's gifted into the trust to pay the premiums, the donors can't get the assets out of the ILIT. We review policies for clients who say they have this money in their ILIT and they want to stop paying premiums and they want to get the money out. Well, in my scenario, mom and dad can't get the money out. The trustee would have to pay benefits to the beneficiaries of the trust, which can't be mom and dad. So if you want to get money out, the trustee has to pay the benefits to the the trust beneficiaries, who are more than likely the kids, and generally that's not what anybody wants to have happen. But in that sort of scenario, most often what we look at is stopping premiums, taking the current cash values that are inside the ILET that the parents can't touch, and doing a 1035 exchange into a new GUL. There's 1035 and GUL. We're going to talk about both of those quickly. 1035 exchange, or many times we call it a 10, we use 1035 almost as a verb. We will 1035 the cash values. That means we are going to perform a 1035 exchange. Why is it called a 1035 exchange? Well, 1035 is a section of the IRC, Internal Revenue Code. It allows for the tax-free treatment of exchanges from annuity to annuity, life to life, and life to annuity when you have the same insureds and the same owners. For most of your way to explain it would be it's like an IRA rollover from Fidelity to Vanguard. Because the client never touches the money, there's no taxes due, there's no ownership, things like that. It's just moved from one insurance company to insurance company, like custodian to custodian. And that's a tax-free exchange. GUL. The GUL is a Guaranteed Universal Life Policy, sometimes called No Lapse, or NLGUL, No Lapse Guarantee UL. This is universal life contract with underlying guarantees of death benefit based on the timing and amounts of premiums, and it doesn't matter if there are cash values in these policies. In general, there are going to be some early cash values, but more than likely out in the later years, there's little to no cash values. The same principles that make a term policy work are the same principles in a GUL policy. A term policy guarantees a premium, guarantees a death benefit for 10, 15, 20, 25, or 30 years. Same with a GUL policy, except the period of years might be 50 years or 60 years. As long as premiums are paid on time, that death benefit is guaranteed. SGUL. We have GUL, SGUL, Survivorship Guaranteed Universal Life, AKA, also known as Second to Die Guaranteed Universal Life. Policies designed to cover two insureds, most often husband and wife, but there are other, of course, scenarios where there might be a need at a second death of two people. In the big picture, these are generally designed to have the lowest premium for the death benefit. $1 million universal life on mom or dad is going to cost more than a second to die policy for the same $1 million covering two people. When the goal is to pass money on or pass assets or provide for someone that isn't, again, I'll use mom and dad, but mom and dad, a survivorship policy is going to have the lowest premium for a particular stated death benefit or amount of legacy. So, mix a couple of these in here, do a case study. We're going to talk about a 1035 and a GUL. It's actually a SGUL. Clients in Washington have $2.4 million of life insurance and variable survivorship whole life policies. That would actually be, I guess, a VSWL, but those are pretty rare, so they aren't. We don't have common acronyms for them. But these policies are in an ILET. So first off, what I see here is that the design is mismatched. In theory, in an ILET, the goal is to provide a death benefit. So you would, in a perfect world, pay the lowest, gift the lowest premiums possible to maximize the death benefit at a second death because it is a survivorship policy. But this policy is whole life, which is designed to build cash values, in addition to variable. So again, the reason someone really would have a variable survivorship whole life policy is to build cash values, assuming that they are going to have earnings in excess of a normal